Stock market crashes are scary. They can wipe out years of hard-earned savings in a matter of days, leaving investors in a state of shock and disbelief. There's no getting around it. The fear and uncertainty that accompany these crashes can be overwhelming. But they're a fact of life in the market. Just like the changing seasons, market crashes are inevitable. Like a hurricane or a volcano, they're gonna happen. These natural disasters are beyond our control, and so are market crashes. We just don't know when. Timing the market is nearly impossible, and predicting the exact moment of a crash is a fool's errand. Understanding these crashes of the past can help us be prepared in case of another one. By studying historical patterns, we can gain insights into market behavior. Let's take a look at some of the big ones. From the Great Depression of 1929 to the financial crisis of 2008, each crash has its own story and lessons. Think of this as your crash course, if you will, in stock market history. We'll explore the causes, the impacts, and the aftermath of these significant events. Why? Because those who don't learn from history are doomed to repeat it. Knowledge is power, and understanding the past can help us navigate the future. And when it comes to your money, who wants to repeat the bad times? Nobody. By being informed, we can make better decisions and hopefully avoid the pitfalls of the past. The granddaddy of all stock market crashes. The 1929 crash was a doozy. It started on Black Tuesday, October 29, 1929, when the market lost almost 13% in one day. It was a bloodbath. What caused it? Over-speculation in the market, easy credit, and a whole lot of margin buying. When the music stopped, there weren't enough chairs. The crash led to the Great Depression, a period of economic hardship that lasted for years. Fast forward to 1987. On October 19th, the Dow Jones Industrial Average plummeted over 22%, the biggest one-day percentage drop ever. Program trading, where computers made lightning-fast trading decisions, got a lot of the blame. It was a wake-up call about the risks of this new technology. Thankfully, the economy recovered much faster than in 1929. Dot-com bubble burst, the high price of tech hype. The late 1990s were a time of unprecedented excitement and optimism about the future of the internet. The late 1990s saw the rise of the internet, and with it, a whole lot of excitement. New tech startups were popping up everywhere, promising to revolutionize the way we live and work. Investors were pouring money into any company with a .com in its name, driving prices to unsustainable levels. The stock market was on fire, and everyone wanted a piece of the action, but the hype couldn't last. The rapid rise in stock prices was built on shaky ground, with many companies having no real business model or revenue. In 2000, the bubble burst. The overinflated valuations came crashing down, and the market went into a tailspin. Many internet companies went belly up, and investors lost billions. Offices were abandoned, and dreams were shattered almost overnight. It was a harsh lesson in the dangers of speculation and herd mentality. The dot-com bubble burst served as a stark reminder that not all that glitters is gold, especially in the world of technology and investments. The 2008 financial crisis was a catastrophic event that shook the very foundations of the global economy. A house of cards collapses. Remember the housing bubble? It was a period when housing prices soared to unsustainable levels. People were buying houses they couldn't afford with loans they didn't understand. Banks and financial institutions were handing out mortgages like candy, with little regard for the borrower's ability to repay. This created a market built on shaky foundations. When the bubble burst, the consequences were devastating. It triggered a domino effect throughout the financial system. Banks failed, businesses shut down, and millions of people lost their homes and jobs. The world was plunged into the worst financial crisis since the Great Depression. The impact was felt far and wide, affecting not just the United States, but economies around the globe. It was a stark reminder of the interconnectedness of the global economy. What started as a crisis in the housing market quickly spread to other sectors, showing just how fragile our financial systems can be. Lessons learned. Protecting yourself in a volatile market. So what can we learn? First, don't panic. Easier said than done, right? Second, diversify your portfolio. Don't put all your eggs in one basket. Third, invest for the long haul. Ride out the storm. Remember, the market has its ups and downs. It's a roller coaster ride. But by understanding the crashes of the past, we can be better prepared for the future.